Hello, guys. Good evening. Can you hear my voice? Okay. So still got people coming in, so we wait for a while. Yeah, any question before we start? Okay, like you can feel free to ask. Uh, Wait, let me set something up. Oh, might test. Okay. Can I see your small account KB? Because I have tried the link up, but it doesn't seem update anything. Small account, I only have one account, by the way. Uh, so okay, so wait, okay, so can you see my screen now? Oh my God. Okay. Mm, okay. Okay, the screen also no problem, right?
在直销之前一定会有一个人备的。
I got some. Okay. Okay, so come back to the question first. The KB cannot consolidate to the knowledge base. Why? Okay. So how you do the prompt actually? So from sharp limb. Like there's a lot of independent dots. Okay, often notes out, right? We say that no matter pass or fail or KIV, this individual dots just won't communicate with other dots. And there's a numbers of them. Okay, you can try to do like one prompt says that to Nyrobrain to say help you to reindex the knowledge network, just like that. Yeah, you try this prompt, then should be okay already. Yeah. Let me show one of mine. I remember I got this something like that. Because last time I do the migration, right? If you guys still remember. So because now currently the knowledge base is like this one. Okay. So I'm doing the migration of my knowledge base from the external sources I have. Wait. Yeah. Here. So what I do is this chat, reindex and connect the knowledge base. So he just helps to do. So a lot of orphan nodes. Okay. So he will do the reindex by the keyword is reindex. Basically, he's like going through all the nodes that you have in the space, which is the knowledge base. So he will do the study and also try to link between with the concept, with the category, and things like that. Okay. It's this one. Okay. So when you started off, got your alphas, you will launch in demo before going off, right? Do you hesitate and doubt your alpha? So every alphas that's being discovered will be run into the paper trade. And the paper trade function will be out by this week. Okay, I already confirmed with the quant dev department. Okay, so they will make sure to ship this important features so that to make sure that when you go to live test, it will still supposed to uh, be effective and also working. So means that it doesn't have a very fluctuation performance compared to your backtest performance, like in terms of sharp, okay, drawdown and the volatility. Okay, so today we will talk about is the portfolio, all right? Because before you go and deploy, you must form your own portfolio first. So after you form your own portfolio, and you also can backtest your portfolio, and then you can deploy. So either you deploy into paper or paper trades or even live trades. That's the important steps that you need to set it up. And it's also very simple. Later I will show you. Okay. Now help me to reindex my KB. Okay, you can try. Okay, you can try. And if you want to be like more specific, you can like you can say that try to avoid any orphan nodes unless it is necessary. So this is how the prompt I did. And also let me check. Yeah, knowledge base sync. So let me show you a bit. Wait for it to load. EDA thought process methodology if time allows. I think EDA will cover next round because it's like quite a huge topic. But anyway, I already showed some of the videos like in a systematical way because this is some of the pipeline that because you need to have some time to really watch through the videos and also even repeat it, so to understand and like fully digest and understand what it is about. Yeah, so we will shoot we already shoot a video, so we'll do the editing. Then after that, we will like showcase on the Nyrobrain official academy videos. Yeah, so but of course I can still explain it about it on the next session maybe. So today we will focus on one topic first, which is portfolio backtest, because once the paper trades deployment is launched, so that you guys can like right away to test it out. Let me ask. So from Ken Pang, for origin filter, I think there are two parameters, windows and threshold values. So should we also use 9.3 train test? Yes, 7.3 for the simple one. Yeah, you did, because everything that you are doing optimization in like finding the best param. Okay, so you need to use train set. Yeah. So everything on the blind test should be like total, like you are taking an exam, so surely you will not know for the official exam what the other question that's coming out. Yeah, so that to make sure that we don't cheat and also don't have any look ahead bias. Yeah. Okay, so like anyone, okay, after like few weeks pass already before it starts, any of you like already have built your own pipeline? And if you build your own pipeline, you can type pipeline, okay? So then you start running backtest and starting to find some alpha, you can type alpha. So I just have a rough view on how you guys like doing great or doing just okay. Okay, Crimson, okay. And what's the blocker if you can tell? Deploying the demo, writing the script. Deploying the demo? What do you mean by that? So others don't do anything. So just Crimson. I built pipelines to using 631. 7.3 split good Sharp ratio, but 631 is negative result. Can you advise? Wait, okay, 631, the pipeline is negative result. Can you advise? Okay, this one got one thing that you need to take note is that depends on what time interval you are in. So let's say, okay, because 631 you are taking as like 6 months, 3 months, 1 month, right? You can tweak a bit about the, okay, it's simple. If your trade counts trigger low, and you need to have a larger step size, which is the 631. The one is what we call step size, or the test set data, so that to make sure that you have enough sample size to do the training, okay, which is a 6, and the 3 is for validations. So to make sure that the trade count does fit a significant amount as the sample size is sufficient, so that your train set are really training in the way that that fit the market dynamic. Because when we're trying to like optimize the parameters, is we're trying to find the best output in case of the parameters so that we can run a good performance during the test set, right? So if you are using like maybe a day or even like 4 hours interval, 1 hour interval, so you can tweak a bit with the time step size with the 631. Maybe you can turn it into like 933, okay, or 633. So you can like slightly tweak a bit because 7-3 split already proved that this is a good alpha. Just that you need to somehow try to fit a more suitable time span of the step size so that the alpha can have enough time to adapt. Because if the step size is too small, there's not enough sample size for the alpha to fit to train and fit the best optimal alpha. So it's like you are seeing a picture, but you're just seeing at the small part of it. So you need to like spread it out your step size, okay, to really look at the bigger picture. Yeah, so that this is what you can do. Do you tell your param on IS or OS and full together? We'll do the IS. IS is the optimization part, always the test sets. Yeah, so like 631, you're training on the 6, okay, then you're using validation on 3, then you're running on 1. So the 6-3 is do the cross validations. But I think, okay, to be honest, for beginners, I think that the another step you can go through before you go to the cross validation, which is the case that we are talking right now, you can do just a simple rolling walk forward test. So like, let's say it's like still 7-3, but instead of using the full time span of, let's say you are doing a 4 years back test, so you doesn't like use the first 3 years as a train set and the last 1 year for the test sets. You just like maybe you do the step size of like maybe 6 months. So every 6 months you have the 7-3, 7-3, 7-3. So the 7-3, the 3 maybe is like, okay, maybe I draw uh okay okay, something like that. So this is your train, this is your test, right? So when all the test case being stitched together, so it becomes a one full performance or the equity curve. Okay, just imagine right here. So this is what we gonna look inside or into the performance equity curve. So let's say the train set, okay, you put, okay, so like maybe like this. So from here to here, so here the full time span is, let's say, 6 months. Okay, so let's say you are spreading into 4-2, let's say 4-2. So train set is 4 months. Okay, or like you want to do it so also can. Okay, to be more simple, you can do it so. Yeah, something like this. So this one, 3 months, 3 months, 3 months, 3 months, so that all the lifespan here is a year. And you just continue on and on. So this is what we call simple rolling walk forward, or just rolling walk forward, without a cross validation. Yeah. So this one like clear. Then if small step size hard to produce result, why do people still use 1 month? For 1 month is like for some kind, like for the shorter time span, not time span, the data interval, like the higher granularity of data. So let's say like minute data and also 15 minutes. So most probably will be an hour and below. So for those kind of interval, because you have a more higher frequency of doing in and out of the trades, so that you have more sample size. So like more things happen within a 1 month time span. So that is like more makes sense to use 1 month to do the adjustment every month. So that's why 631. Yeah. So for normal case, for hourly data, I would suggest like 963 or even like 966, something like that. Because the 9 is quite important, because if the 9 doesn't have enough sample size, you can barely do any good training for the for the test set. Yeah, that's why here 6 months, 3 months. So as you can imagine how many rolling step it will take for 4 years of data, it will probably takes like 4 times 4. Because like 4 steps goes for a 1 year. If the 4 years of data, you are rolling for 16 steps to run a full back test. Yeah. So for this one, the good side of it is that you can try to, like, you can simulate the exact simulation when you are by using this backtest method, because this will, the first thing, he can adapt, and also you can have a more longer period of testing whether this strategy is robust or not. Because for 7.3, the simple one is still a good framework, and we still did use it. And sometimes we just skip the rolling walk forward, is that we trying to find, because like let's say we are using the 7.3 simple walk forward backtest, okay, the simple one, okay, just in case you guys not sure what I'm talking about, maybe I just put it here. Okay, so something like this. So this one is simple one. Three years. So this is what we call simple 7-3 split. Yeah, you get the idea here. So for 7-3 split, if like currently the out of sample is running good, and we will straight go for the paper trade deployment, and to keep on tracking whether the performance is like running stable or not. So to deploy in the way using the 7-3 split. So for this rolling walk forward is like most likely use cases like for those like that alpha that strongly relying on the regime change. So he need to be more adaptable, so that he know like on each of the regime whether he need to change the parameters. So if the strategy or the alpha property is that you no need to really change too much about the parameters, you can just keep it simple by using this one. Okay. And I suggest for beginners, okay, when you're starting, you just use this first. And the second thing that you can try is use this. Because like if you ask me the reward of doing the better adaptive thing is like using the regime filter. So like I will like spend time and effort on the regime filter before I trying to use this as a adaptive functions for my alphas. So what I mean by that is if you can already target the right regime factors to help your alpha to like really avoid during the bad regime and also know how to take advantage during the good regime, then it's already good enough. Because just to remember what is the purpose we are using this rolling wall for. First thing is for robustness. The robustness is mean that all the stitches about the test set, you can have a full view of the most honest report. Okay. And also the second one is to try to adapt the parameter change or the optimal parameter change. So if your alpha is like quite stable, the parameter doesn't like change here and there quite often. So for this one, it's like good enough because you are using the most amount of the train set, which is 3 years of data, and try to find the best parameter setup or configuration and test it on 1 year. So during here, if like it's still producing good result, then it's still a good case. So it's like not a like fixed answer that you must use this or not. It depends on the alpha and also like whether the alpha is like really needs special treatment on like regime filter. Because like if you're using rolling wall forward, yes, he can do adaptive. He can adapt accordingly with the regime, but it's like a passive way of doing the regime filter. Because when you're doing active regime filter, it means that you are really matching the right regime factors for that particular alphas, and you can predict like during the regime factor maybe it's low or high. He know that the alpha know that whether you need to stay out of the market or participate in the markets. But using the rolling wall forward, what he can do is like he try to adapt every 3 months of the step size and try to adapt with the most recent markets. So it's like a passive way. It's not predicting anything, but it still can have the adaptive power, but not so strong as the regime filter. So can I understand this one? Yeah. So this is like how you think and how you choose what kind of method to use. So I know it's like a bit complicated, but the most important thing is that you need to understand your alpha story. Okay, so when you have a strong alpha story, then you will use the filter, your so-called your understanding on the alpha and try to understand whether it's like regime adaptive alpha or that is doesn't necessary to do too complex because the alpha itself is already have the predicting power as already as a leading factor so that you just use the simple one will do. It's not like the more complex it is, it will help more, but the right fit of model and right fit of method is more important. Yeah. Is there a guideline to follow? Like 1 day must at least 3 years of training data. 1 hour. Okay, last session I already mentioned this. Why I always say is that 4 years is important. Is that okay? First thing we all know that in crypto market there's always a cycle of 4 years. Because like 4 years we will go through a bear market and also the bull market. So we're trying to give our alpha have the environment to stress test whether he can do well either in the bull regime and the bear regime, right? So that's why it's the 4 years of that's why there's a reason we're using 4 years. Then why we are not using like 6 year, 8 year, 10 years is because this is our discretionary idea because based on observation, like every 4 years after the bull market, the market participants and also the whole market environment is changing. Different market player is coming in, different policy, and even different player, different kind of mentality in the game. So in like you just imagine like it be like 5 years, 10 years before, like buying Bitcoin is like a degenerate things. So people would not treat it seriously, okay, and also with high leverage because some all the people coming here is like for gamble. But after that, after 2020, okay, in this institution start coming in, Michael Saylor coming in, okay, BlackRock coming in. So like the scenario is like changing. So that's why the 4 years, and also like compared to like the timing that when the market player is changing, that's why we're trying to like stay adaptive as well. Because we are looking back for the latest 4 years of data, it's like it's the same environment we are trying to capture, but instead we're not trying to capture the old market environment data. That's why we use 4 years. It's because like things keep changing, players also keep changing, game rules also changing. So if you are using like two old ways of the data, so that maybe it's not so useful based on our experience. Of course, you can do that, but it's like different for crypto because crypto is like really emerging asset class. It's not like stocks and like S&P 500 and things like that. So like for stocks, I believe for longer the data is like better. But for crypto, based on our observations, like 4 years of data is like just a sweet point. Yeah, but I'm not saying that you should not use 6 years, 8 years, even 10 years. If you can do it, so then you can just have the answers and also the decision based on the backtest result. Then you will get the info. If you are willing to do the extra amount to test with different time span, okay, 4 years, 5 years, 6 years, that is also a good thing that provide you extra insights. Yeah. Okay. Cool. Okay, very good questions, by the way, from BG and also Crimson, and also from Sharp and Keng Pang. Okay, so without further ado, then we talk back about this main topic we're gonna say about this. Okay, so like now we talk about the portfolio backtest. So as you can see, there's a function button here at the strategy dashboard. So how to form your portfolio is like you just type something like this. Okay. So you just type this prompt, okay, group all past strategy into one portfolio and backtest them. I just type in the chat. Okay, of course, you can be more specific on what kind of alpha, what kind of strategy you want to include in your portfolio, because like all the strategy is here, right? So you can say, okay, I want to have all the past and review strategy, which is what I did. Okay, I want to have this tool of portfolio in my, and to form the portfolio so that, and you help me to do the back test. So I want to see after all the alpha being combined, is it good and or bad, and how was the performance? The Sharp is how much is the Sortino ratio? Okay, so after you do this, because like in your file explorer, okay, let me see whether you can look, because my file has a lot of folders. Okay, can. So the pipelines we already added here. You can change whatever you want. So the pipeline to portfolio backtest. So you can read through the details. Okay, what it's gonna generate as a report for the portfolio. You can track it out. And this is and you can, of course, you can edit if you want. Even that you can ask Nyrobrain to adjust and amend the markdown file here. Okay, you just give it the name. Okay, then you just ask, okay, I want to change this file in the way that I want, blah, 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 A, B, C, D, E. Okay, so after he done the job, okay, it will include in the strategy dashboard here. So let me share about how you can analyze and also about how you interpret the graph and reports here. So this is the generator on the 20th of, no 20th, 12th of June. So this is all the alphas. Okay, so the return, the Sharpe ratio 2.43, Sortino 3.7. So this is the equity curve starting for 2022. Okay, it's like all out of sample. Okay, the drawdown and the Sharpe ratio, the rolling Sharpe ratio, the monthly returns, So the first thing here is the correlation pairs. Okay. So the correlation pair is to in the descending sequence, as you can see, the top correlated pair of the alpha, it will be ranked on the top. So I will see that because like if the alpha inter alpha the correlation is too high, means that it's most probably the alpha is earning the same money because it's had the same timing going in, okay, entry the trade, exit the trade, mostly at the same timing. That's why there has a like the very similar P&L series, which is the equity curve lah. So as you can imagine, these two alphas has the really similar equity curve. That's why it's ranked at the highest. So why we don't want to have the similar alpha together is the first thing, we don't want to over tilt our allocations to the same alpha twice, even 3 times. Okay, because this will cause imbalance of our allocation in the portfolio. And the second thing is yeah, we don't want to we also want to let Nyrobrain to know that avoid to find this kind of high correlated alphas ideas so that you don't like keep finding the same alpha with just a different name. Okay. So you just keep like seeing that, wow, there's a lot of alpha being discovered, but it's all the same alpha. So that we're trying to have more different alpha in the terms of like low correlations so that you can have a more diversified portfolio. So why we need to have a more diversified portfolio? Let me find a graph for you. Because of the more it diversified means that your portfolio will have more improvement in terms of the portfolio Sharpe ratio as a whole. Give me a second. What is like because of mathematically, like let's say like you have two alphas. So one of the alpha, let's say alpha A, and another one is alpha B. If both of the alpha, let's say, have the Sharpe ratio of 2.0, if you are combined into the portfolio, means that if you just simply give an evenly distribution, means like 50% allocation go to A, another 50% allocation go to B, and the portfolio Sharpe ratio as a whole will become higher in terms because depends on the alpha correlations. So that if the correlation is high, because it means that it's the same strategy that has no diversification effect in it, so that the Sharpe ratio improvement would not have a big improvement, even have no improvement. Okay, because it's the same strategy. By the way, now you guys can hear me because my hello, you guys still here? Just now, I think the internet disconnected. Yes, okay. So where I left out just now. No problem for me. Okay, no lag. Let me share screen again. So now no lag, right? Now, someone say couldn't hear. Okay, let me show the one of the mathematical proof for this. Correlation versus portfolio. Yeah, this one. Okay, so this is some of the mathematical proof, but I want to let you guys to see this graph. Okay, so still remember how we compute the Sharpe ratio, right? Okay, so the mu1, mu2 is the annualized mean return of each of the alpha. So we have two alphas, 1 and 2. So have the same return, let's say 0.15, but the standard deviation, which is the denominator, we're gonna divide, okay, with the so-called mean returns. So let's say we get a Sharpe ratio of 0.75 and 0.5. So as you can see, after do the combinations, there will be a range between 0.6 to 3. This is a Sharpe ratio after doing the combine. So after combine, you can see that if the correlation is 1, as you can see, there's no actual improvement. So the Sharpe ratio is like at the y-axis is around like 0.6 or 0.7. So that it's like a mean, it's like a really average out between the two of the Sharpe. Okay, because it doesn't have a diversification effect. So even like 7.3, okay, let's say like both of the Sharpe is like 0.75. After combine as the portfolio, if their correlation is 1, so just simply means that their correlation is the improvement of the Sharpe ratio would not have 0%. So means that it still would be 0.75. Okay, but the further down, okay, when the correlation is getting lower and lower, even negative, as you can see, even the Sharpe is like 0.75, but if it's like total negative correlated, it can go up to as high as like 3.0. Okay, so this is why the correlation thing is important. Okay, so this is the graph here. So what is the metric for me to think that is sufficient? I would say like 0.66 and below. So for this 4 alpha here, maybe we need to like filter out and choose just one of it to run in our portfolio. Okay. No lag, right? Because my monitor just popped out like saying, remind me the internet is not stable. Smooth. Okay, then just continue. Okay, so 0.6 and below, then we will just keep on using. And this 4, maybe we need to do some adjustment. So most probably they are doing the same strategy. As you can see, the naming even is like quite similar, right? So this is also a really good filter like to do the ranking so that you know that which kind of alpha you need to like eliminate is like an extra thing. Okay. And this one is you can see across like all the alpha you have here. Okay. And to compare across the time series. Okay, so by the way, all the graph here is already embedded in the markdown file we have just shown you guys previously. So you guys, after you do the portfolio setting up with the prompt just now I sent you, you will see all the following graph here. So like across the time, okay, which of the alpha is making money? The red one is like, okay, have the loss of the P&L and so on. So of course you want to see all the graph here as green as possible, and the red has least as possible. All right. Is it Pearson correlation? Okay, but that's a good question. So we are using yeah, Pearson. We are not using Spearman. Yeah. So the difference of Spearman and versus Pearson. Let me check. Yeah, we are using Pearson, yes. Okay, so the difference of PM, let me show you. Yeah. So for Pearson, it's like for continuous data and it's sensitive to outliers. And our equity curve is in continuous sequence, right? So that's why we're using Pearson. So for Spearman, it's like using the ranking stuff, and resistant to outliers. So it's like not sensitive to outliers. Yeah. So we are using Spearman. Yeah, different case scenario. For financial data, we mostly use the Pearson one. Yeah. Okay. Here, I think. And Pearson, he does like consider in the magnitude as well. It's not just like positive one or negative one. He will include the magnitude as well. Yeah, that's why we use the Pearson. So for those ideas that got around 0.6 sharp, we could do a popular correlation test first before we fail it. As long as you got the heat map, okay. If the heat map is telling you that the surrounding parameters that you have is stable, then you can use. The most important thing is like to have a stable region of your sharp. Okay, let me find whether I can find that. Let me check whether I can find. Yeah, something like this. So you need to have a big surrounding. If all the surrounding here is green, mean that the alpha is still okay. Just that you need to, the second thing might be you need to think about it is like maybe how you can use the region filter to minimize the drawdown. Because like most of the time, if you can get a big green area, but you still have a relative low sharp, it's just simply that your alpha do not know how to avoid drawdown period. So how you can avoid a drawdown period is like simply implement with the right regime factors. Yeah. Just need to be 3 times 3. I would suggest 5 times 5. But this is also like an arbitrary number is because it depends on how granular of your parameters between the x-axis and the y-axis. So how close it is. The finer it is, of course, you need to have a bigger surrounding steps. Okay, maybe even 10 times 10. So that you need to have a reasonable range because it's all about the relative scale that you're trying to capture. So for this one, okay, I would say 3 times 3 is 3 times 3 is like sufficient because of z-score. Okay, 3 times 3 or 4 times 4. Yeah. And you also, other than that, you also need to like try to observe the surround here. Is it like there's some only some of the area have some green peak? That's not a good sign because just that all around is still like surrounded by the orange or the red pad. Yeah, so we need to like have an even spread green, and the even better case is that he has the slow decaying trend when you are moving out of your optimal param choices. So it just means that okay, now here is 2, here is 1.8, 1.66, 1.5, 1.4, 1.3, then it's considered okay. Means that you are really finding the good parameters, and all the surrounding here is still have a very consistent performance. Even like if let's say in the live market, you will not find the optimal alpha, optimal parameter always one. So you need to have a buffer surround so that you can still capture the profit, even like the optimal param have already like moved to here, but you still have a green surrounding so that you're still making money. Yeah. So of course, first thing, the greater the green area it is, and slower the decay around the parameters surroundings, that's the best case. Yeah, so this is the important thing that you need to take note only. Yeah. Okay, so this is the P&L. So this one is the exposure. So the exposure is telling you that like how high of your capital capital allocations, not capital allocations. capital deployment. Okay, so there's a BTC and ETH, there are net exposure. So as you can see, like if you we have 39 alpha about BTC and only have 7 alpha on ETH. So what is the bad thing here is that the exposure for BTC is okay. The max exposure is 50%, and the mean is like the average exposure is around 16.5%. Okay, the mean is like the lowest. Okay, means the red one is like doing shorts, so that the max short exposure is like 10%. So here come the ETH. The max is 13, the lowest is 10, then the mean is 1.3. So as you can see, this is the total net exposure. So the max is 56.5, the average is 17.8. So means that if you because this is assumed we are doing 1x leverage, so that you can see that the max position you will open is like 0.56x of leverage, because it's not going to use up all the capital. But in doing futures, doing perps, actually you can adjust your leverage accordingly. So that let's say you want to make sure that you have a max exposure on 1x leverage, because just means that you doesn't have the chance of getting liquidated, so that you can use like leverage by 2 actually. So like 56.5 times 2 is around 110. So this is your max exposure. So your average exposure is around like 36%. Okay, 35%, sorry. Yeah, 36 if you add it up with the decimal point here. So 36%. So manageable risk. So you not face the liquidation risk as well. So this is for you to adjust your leverage and also adjust your exposure, your average exposure. And of course, you also can rebalance based on your max drawdown. Okay, so let's say your max drawdown when you are running the backtest, you're assuming all alpha is what? Let's say just this portfolio. So the portfolio here is like saying that the max drawdown is okay, 3.1, let's say. So if you can bear the max drawdown with 30%, so you can technically times 10x of leverage. But let's say, okay, because even 10x of leverage, the mean is like 1.7x of leverage in the mean, because it's 170%. So the leverage is like 1.7. Okay, the mean means that if you have $10,000 in your account of the capital, so the mean of the position you're having the exposure is like around 17K. So this is what I mean, the 1.7x of leverage. Okay, because here, but if it's good to have some buffer, because like if you can take the hit abroad, like as high as 30% of max drawdown, and your performance report is telling you that you only have 3% of drawdown. So what you can do is you can times 10 and you divide it by 2. So you try to rebalance your max drawdown according to your performance report with the 15%. Yeah, so this is like how you can manage the risk and also be conservative enough, but not over conservative. You still can have your capital efficiency being considered. So that's the best case, the best balance. Okay, so this part, understand? Can understand, you can type okay. All right, so the next one is okay, this is just a drawdown. Okay. By the way, you guys know what I mean when I say all the alpha combined. Okay, so I just have a brief sharing about this is you just imagine like here we have around 46 alpha, so that you just imagine you have 46 traders that are under your so-called your pot. Okay, it's trading for you, and you have around 100K of capital, let's say. So you can do as simple as just like evenly distributed. If you are like the new quant trader, quant researcher, that's the best way, as you can do all of the testing accordingly. the best case is for you to do evenly spread, as long as the alpha individually internally is like have a low correlation. So that's the best case. So that in the portfolio here, even the markdown file is suggesting as the default to do the evenly spread according all the alphas. Okay. Of course, in the advanced stage, you need to do the clustering and do the alpha category grouping batches and try to cluster dynamic allocation accordingly and based on region filter also. But that's one is like the advanced stuff. I think no need to go deep dive on that rabbit hole first. The first thing first is that you need to focus on finding alphas first. Because if the alpha is really good, even how you do the allocation is like you are trying to max out the curve towards the right side or the left side. So left side, if you are trying to optimize in the wrong way, of course you're going to the left side. Means that you are if like you just normally distributed evenly, you can make money. But if you are allocating in the wrong way, in the long run, you still make a loss. It's just like have the limited shift between your P&L distribution, I would say. So the most important input is still how you can provide a good alpha. So even without the like those kind of complex maneuver of the allocation within your portfolio, will be always perform better already. Okay. So what I would say. Okay, so evenly distributed and also for mathematically is like because your portfolio is meant to be diversified across the alphas. So if you evenly distributed, you also have the most diversified effects when you're running a portfolio, which is good because each of the alpha has already proved they have the statistical significance of making a profit. So whenever if the correlation is low, means that the alpha is making money a bit and alpha B is making a loss. But overall, because since that individually the alpha already have the positive edge, so in the long run, the making money side of the alpha is always gonna have a surplus compared to the one have a losses. Okay, so in the long term, you will get a smoother equity curve, and hence that your Sharpe ratio will be increased as a whole. Okay, so people have some questions. How do you compute that when you have alphas in different time frame? Okay, very good questions. Nyrobrain will do all the resampling for you already. Yeah, that's the part that is the hidden part that you guys, if you are not a manual researcher before, you will not feel the pain. Yes, indeed, Crimson point out a very good questions that the Nyrobrain already pre-trained in a way that if you do the portfolio backtest, it will automatically resample all the data to the finest granularity it has. Okay, because the finest granularity is 1 minute. So it will do the auto resampling for you guys. Yeah, so that you no need to compile all over again and try to form a portfolio and try to remerge everything and just to have the portfolio backtest. So the same thing goes to when you are doing the live trades, all the thing will be auto resampling for you guys. Yeah. Because in the beginning, we also like spend a lot of time like doing all these things. And when we first time doing some stress tests, there's a lot of bug. And because like some of the thing you just cannot expect and just happen. So, but we already fixed it and we already ran this for like 4 years, 5 years. This is our internal system. So I would say that it's confident for you guys to just use it for the thing that we already cluster for. Not cluster, crystallize for 4 years of time. Yeah. Okay. So I think answer the question already. But I have to do clustering so I can apply regime filter better. Yeah. Okay, what do you mean by clustering? Is it on the portfolio level or the alpha level? When I say clustering is that when you have a portfolio, you have like 50, 100 of alpha or even more. And you need to have the algorithm to do the cluster, to do the grouping. Yeah, you need to do cluster for advanced level, yes. Yeah. And most probably you will touch some machine learning concept, but not like really machine learning. Okay, it's like use some of the concept and algorithm to help you to do the grouping. so that the machine will know how to allocate accordingly to different groups throughout the different regime period. Yeah. Alpha clustering first or regime filter? Regime filter on alpha level first, then alpha clustering. Okay, there's three cases here. So the first thing is the alpha level regime filter, and the second one is the portfolio, the alpha clustering. Then the third one is only the portfolio regime. So it's like going from the bottom up procedure, because you are trying to solve at the low level whether the alpha itself is good enough. So when alpha is good enough, you already proven that you have tried your best to make the alpha individually already running very well, so that you only solve the second problem. You don't solve the top problem when you have the alphas that's very sucks. Then you're just going nowhere. How you tune it is also like not gonna do it well. So I would say that alpha, the quality is the most important thing. Okay, your alpha story, how you observe different data and use it as your leading factor, okay, to predict the price movement. And the second thing is a regime filter, because if the alpha have the predicting power, but he has a weakness of how to avoid the market regime he is not good at. So you need to have a regime filter to protect the particular alphas. So after you do this thing, then you can start to form portfolio, right? So when you do the portfolio, then you need to do the alpha clustering. So alpha clustering means that you need to know which batch of the alpha are the same category, okay, or they share the same regime, I would say. Okay, so that he know that when certain regime or certain market condition happen, this kind of alpha you just keep it, avoid it. Okay, so even that allocation method can do the allocating resources, allocating capital accordingly throughout the different category of the alpha clustering. Then only the last thing is the portfolio level of regime filter, which is, I think, is really optional. It's not like necessary, because if your individual alpha already have the capability of catching the regime and know how to extract the value to the max in different kind of market conditions, so that the portfolio level of regime filter is like kind of extra. So for the portfolio level of regime filter, is more of like a risk control lever. Okay, so that to avoid like max drawdown happens, okay, or avoid some of the big market event. Okay, let's say you want to avoid when market have a big volatility and you still have a really poor result. That's why the portfolio level you need to stop. It's like a risk management thing. So it's like a different thinking lah. I'm not sure you guys can understand what I'm saying this. Yeah, so you always start from the most fundamental thing is your alphas. If your alpha is going good, even how you tune it, just even like the most simple allocation method, the evenly spread, is already good enough. Just to make sure the alpha doesn't have high correlation, that's it. Or else, if your alpha has a high correlation, means that if all of the alpha of that category going have a poor performance, have a big drawdown, then you will get fucked up, because all the allocation is tilted towards the batch of the alpha. And some of you guys, maybe you will max out based on the Sharpe, or let's say some of you guys will do allocation according with the Sharpe ratio. So you just do the weightage according to the Sharpe. The higher the Sharpe, then you will give more allocations. So if suddenly all the alpha is just going to not work for that particular month, then you will just fuck up. Yeah. Can I ask, token quota will be refreshed monthly, right? If you purchase the yearly package? Yes. Yes, if you buy the yearly package, you will refresh every month, like just like COD lah. Yeah. Okay, so we continue. So okay, this one, the market beta. So this is also quite important. Okay, as a reference. Okay. So how we interpret this data is, yes, as you can see, the y-axis is the portfolio daily return. So each of the dots here is representing the portfolio daily results. So like 4 years of data, okay, how many days it will have how many dots here. Okay, so for the x-axis is the daily return of BTC, because we are trying to use BTC as a crypto benchmark. Just like when you are trading stocks, you are trying to outperform the S&P 500 or the QQQ, which is the NASDAQ index. Okay, so because why you need to benchmark BTC is that if you cannot outperform BTC, that means that it's more effortless and more easy for you just to buy Bitcoin, buy and hold. You don't need to like spend a lot of effort, okay, doing here and there, run quant research, coding stuff, just to doing some low performance compared to BTC. Because if you can buy BTC as the asset to have not bad result, then you just buy and hold. So we are here to outperform BTC, just like whatever hedge fund is trying to outperform the indexes, right? Okay, so this is important. That's why we need to compare so that we don't just like shocks and delete. Okay. Okay. Okay, so as you can see, there's a fitting line here. Okay, this is the red line. So the red line here is the slope, okay, which is like in the math. Okay, how much you guys like, how many of you guys still remember y equal mx plus c? Okay, I think a lot of you guys already returned back to your teacher already, right? Okay, so y equal mx plus c. So y is the dependent result, okay, which is like when you need to have the inputs, the x is the inputs, am I right? And the m is a coefficient, or we call the gradient. The gradient means the slope lah. So the higher the value of m, which means the slope will be more steeper. Okay, so if like more negative, it will be have like this of the shape. Okay, so what is beta? Beta is also mean that how correlated of your portfolio daily return is similar compared to the benchmark, which is BTC. Okay, so you just imagine if the dots is like all fitted according to the line and have the 1-to-1, because if the M is 1, just means that the line of the red line here will be at the 45 degrees. So it's exactly the same, means that if the daily return have the 0.1, okay, the return of the BTC also have a 0.1. So it will fit the 45 degrees of line, because it will just match whatever result of your portfolio according to your BTC returns. Does it make sense? Okay. If you can understand this, it's okay. Yeah, but it's okay. I'm not trying to complicate things, but this is like simple things. Then you need to like visualize it, and after you understand it, it's like really simple. It's like just comparing different results according like compare with the BTC and your portfolio returns. So just imagine if BTC make 10% today, you also make 10% today. It's exactly the same, just like the correlation is exactly 1. So if the correlation is 1, you will see that y equal mx plus c, the m will be also 1. But in the financial world, the financial realm, we don't say m as slope or gradient, we just say beta. So next time when you seeing some quant researchers saying beta, means that the risk of your portfolio compared to the markets. That's why the hedge fund always says that we are finding alpha. Where does it coming from? Is that the alpha is actually represent the y equal mx plus c, the c. Okay, the c of the mx plus c. Because again, the c in the mathematical world is what we call interceptions. The y interceptions. Y interception means that if the most ideal world, if you have a max alpha and with 0 beta, this is what every hedge fund is trying to pursue after, which means either your benchmark, which is the BTC, trying to go up or down or even going circle around, you still not have any effects of it. Means that you're still making a profit, okay, and not affecting by the market, which is BTC. Okay, so we will find that the line will have a parallel to the x-axis and have a high y value interceptions. So interception just means that let's say I draw here. So this is a line. So if I want to have a y interception higher, I was like something like this. Okay, just imagine. I can draw a straight line or not. Okay, just bear with me. Okay, just imagine this is a line. So this has a higher interception, right? This is the y-axis, right? So when the y-axis has a higher, this is what we call alpha. This is alpha. That's why we always say we are trying to find alpha, find alpha. Alpha just means that the excess return that you can make without affecting by the market. Okay. So if the alpha has, if the beta is 0 and you still got the alpha, the line is something like this. Parallel with the x, and you just can imagine all the dots is like here. For this, the slope line here, all the dot will be something like here. Okay. Okay. So, okay. Beta, we want to be either way above 1. Okay, the max of the beta is 1 only for the financial world. Would they have? No, it will not have higher than 1. Yep. Let me double check by the way, but I never see that a higher one because unless you are doing leverage, that's a different thing. Because if you are using 1x, it's not gonna have, okay, it's not possible to have higher than 1. Okay, you just imagine if you are making, if the BDC has the 10% of the movement and you have 30%, then it's not correlated with the Bitcoin already. Okay, so that it's like a correlation. Okay, so that it will be either negative or positive 1 as a max. Okay. So that's why we have the thing called Jensen's alpha. This is not Jensen Huang, by the way. So if you can go and I think some of you guys have researched this term called CAPM decompositions. So you just basically use the mathematical formula and try to explain the portfolio returns. Okay, this is also where does the alpha terms coming from. Okay, it's the interceptions. So what it does is that it decomposes based on, okay, this is the red color is our portfolio performance, the equity curve. And the gray color is using the portfolio returns and multiply by the beta value, which is the 0.165 here. So the beta of 0.165 is still considered quite okay, quite good. Okay. Means that the portfolio of this is not affecting with the BTC price. Yeah, so either BTC like it's going down, I still make profit. It's going up, I still make profit. Okay. So after minus out, it will get the green line. So the green line is because based on the formula, the beta times the BTC. Okay, right? If your portfolio minus the BTC beta, it means equal to alpha, right? Okay. So the green line after the subtractions, it means the pure alpha that you have. So what we want is that if the green line can be more nearer towards the red line, which has a higher value, it means is the better one, means that the alpha is true. The excess return that your portfolio can contribute is higher. Okay, because the green line will never exceed the red color because the red color is minus something out and you produce a green line, right? Okay, so if the beta is lower, means the gray color is even lower. So after minusing out, the green color will be higher. So this is the Jensen's alpha. So next time, if people asking you the Jensen's alpha, then you can answer them, which is the excess return you have of your portfolio. So as you can see, just now here has the alphas, right? So alpha is equal to 0.000048, means it's the daily excess return that the portfolio is contributing. So after you analyze it, means that you just times 365 days. So you will get your excess return of this portfolio is 17.7% per year. Yeah. So the greater of the weightage coming from the alphas will be better. Okay. So this part understandable, easy. It's not rocket science. If okay, type okay. If you have a question, you can just ask. Okay, so it's pass. Okay, equal weight 2.43. Okay, this one is a block bootstrap. Okay, some of you guys have maybe heard about Monte Carlo. Okay, Monte Carlo. So it's like doing multiple trials. As you can see, but instead we are not doing daily, because daily you are just shuffling and try to destroy the whole sequence of your initial equity curve. That's not what we're trying to do. So that we are doing block by block. So you just imagine here we are setting 30 days by default. Okay. So even though you guys doesn't set anything, this is the default setup. So we run 2000 trials, as you can see here. And 30 days is the block. So that let's say you have 4 years of data. So it will spread like every 30 days, so that like 1 year have 12 months. So 4 years have 48 months. So we will have 48 blocks in total. So it will shuffle all around these 48 of block, okay, which is a time period of 30 days. So you just shuffle. Because why we're trying to do this is we're trying to simulate the equity curve sequence in the shuffle sequence, so that we can study in like 2000 of trial is like just mean that we are running in the 2000 of different parallel universe. And what is the return or the Sharpe ratio of this portfolio can be. So as you can see, 95% CI means confidence level, confidence interval. So after 2000 trials with the block of 30-day shuffles, we can find that there's 95% of the chances that the Sharpe ratio would not go exceed between this range. Okay, so like the lowest will become is 1.32, and the max of the performance will become 3.47. So that this is like you can have the glance view on whether your alpha is like a good alpha, okay, good portfolio. Yeah, of course the lower bound will be higher the better, and also the higher bound will be higher the better. So the 95% confidence interval is this is the meaning of this. And the observe is the mean. Okay, means after the 2000 trial, what is the mean Sharpe ratio that you have, which is 2.42. Okay. Okay, so the PCS grid plot, in the simple term, it just means that the ratio, if it's higher, the better. This is also telling you that telling you the portfolio alpha content, whether it has individual contribution. If the individual contribution of alpha is like low, means that the ratio will be low. So we want to find that each of the alpha has the strong contribution effect and perform it well and perform it differently. It's like something similar to low correlation, but it is have the more credit being given when the alpha is giving like more contribution towards the whole portfolio. So if the ratio is higher, means that it's the better. Okay, so that is the PCS grid plot. Oh, and this is the correlations. Okay, just now we mentioned already. So this one is like during crisis scenarios. Okay, so that you can add like other events in the so-called markdown file, but automatically it will generate like during the FTX collapse period, like the 2024 pullback and also the 2025 dip and so on, and the 11 October sell-off, how your portfolio react accordingly. So within the period, the total return, whether it's positive or negative during that period, and the max drawdown, how further and how severe it went, okay, during the stress test event. So that you can see how your portfolio react to those like black swan event, like this market, like extreme events. Okay. So this one is like just purely the rolling 12-month of Sharpe and with the step size of 3 months. Okay, so that you can see the distributions of your Sharpe ratio, okay, across the different time. So the mean value will be 2.66. Yeah. So you guys can, okay, this is all for it. Okay, you guys can go try it out. Yeah, but before that, before we end the live stream, so any questions further? Okay, sorry, maybe I missed that. Where did 0.165 beta come from? Okay. So it's a fitting process. You can go and study a thing called OLS regressions. Okay, it's just simple. Try to fit all the dots here with a straight line. So the line here is representing all the dotted here when they're trying to match a line that have the shortest distance to this line. Okay, so it's like trying to fit all the dotted here with the shortest distance. So to fit this line eventually. Okay, so I try to find. I can't type. Yeah, this is the. Let me find a graph, then you understand. Yeah, this graph. This is the so-called ordinary least square regressions. So we have all the scatter plot here, right? Because it's for our data sets, because we have the returns of the portfolio and we have the returns of the BTC. So you will have all the scatter plot here. After you do the OLS regressions, okay, he will have the line. So the line will have will have the equations. So the equation will be the MX plus C. So we'll have the 0.165. Okay, means that we have a 0.165 of x plus 0.048. This is the y equal to mx plus c. So the function will be y equal 0.165 and 0.00048. Yeah. Okay, so the x will be the BTC, right? And the y will be our portfolio return. So if let's say the x become today, let's say BTC make 10%. So you can straightly know based on the regressions, how will my portfolio make that day. So you can just do the calculation and just try. So 0.165 times 10%, then plus 0.0000848. So you made 1.7%, something like that. For the beta return, means that if BTC make 10% that day, your portfolio return from beta will make 1.7%. Yeah. So like this, can understand? The coordinates of each point comes from the x. Yes, daily return PY. Yes. After all, the plotter just use regression to find the line. Yes. 100 marks for Kang Pang. Yeah, so if the line is like fitted, it's a fitted line, fitted by using this method. Okay. So the method after you have the line, because every line is an equation. So the equation is just like what I've shown you just now. So when the slope is getting greater, you will see that this will be greater. So that 0.165 become like 0.8, let's say. So you just find the slope will be steeper. So what if I have a negative one? So if a negative one just means that I will have a negative slope. This is what we call negative slope. Because the further the BTC price go, the lower the portfolio return it becomes. Yeah, I'm saying it right. Yeah. BTC, the BTC going up. Yeah. Yes. So so this is -1. Okay, let's say this is 45 degree lah. Okay. So this is 1, the slope. Okay. So when negative slope just means that when the BTC price is going up, they have a negative return because the line is going down. Then the Y have an intersection of negative, let's say. Yeah. Yeah, just that simple. So, and the C is just simply means that how parallelly movement have been moved accordingly. If going up means the higher the C, higher the alpha numbers. Going down means you have an alpha of negative. Means that you will have a you will not make profit lah, or hard to make profit. For the crisis event part, some events not instantly digested by the market. Digested by the market, like yen carry on why. So you can define yourself if you want to include some of the event that the AI doesn't give you, you can add it yourself in your markdown. So you can plot it down even with the exact time period, like like 519, okay, the 2021 519 event, the China banned the BDC and also the Luna crash as well. You can all listed in the markdown file. Okay. So you guys can test this function out. And by the way, I have updated some of the forum discussion here. I'm not sure you guys have really looking into it or not, but I'm trying to try to see what kind of posts that you guys want to see. But I'm trying to give value here. Okay, try to discuss something and giving some idea insights for you guys, so you guys can know how to like really use a good use on Nyrobrain. And also you guys can post some questions because this is like forum. So you just treat it as like Reddit. Okay. So you have any questions, you want to discuss something, because when you do the posting, you is required to do the tagging here. So if you are discussed, you can choose one or two or more. Okay, so that in the future, when we have some good discussion here, so people can participate in to share their own story, their own case study, so we can learn more with the discussion here. I treat this space quite importantly because this is where the community power is gearing up. Because if like in live session, of course I'm trying to give value as well, but it's like a single way of giving sharing. But here, I believe there's some great researcher as well in our community, so that I encourage you guys to share in the forum discussion here. Okay, so when we can make it active, so more people will like have the drive to share more here. So also to help each other. Okay, so that we can get inspired by others and we also can inspire the any other of the guys in the community. Yeah. So I just share like how I do it, the full agentic research here with the 0.2 cents and 0.92 cents of token. It helped me to find like 22 alphas. We have the all sample sharp of 1.0. Okay. I just give it one prompt, which is just this prompt. Okay. I just tell him continue this process until you find 20 alpha, unless you don't kacau me. Okay, my criteria OOS 1.0, Sortino, whatever. Okay, ask him to follow my agents.md strictly. Then he just go and find. So after that, he just find some of the alpha is like quite good lah, actually. I didn't give him any idea. I just asked him to go to my knowledge base and try to avoid all the alpha because I have the labeling of canary alpha. So the canary alpha, because we have around 2,800 of alphas in our existing database. So that one is like humanly researched one. So I don't want to again research all the same thing out again. So I just tell him to make sure to do the untested alpha, which is in our canary alpha group and also our Nyrobrain pod. So pod plus canary. So make sure don't want to do double work. To make sure to don't have the high correlations. So cause we don't want to try to have similar strategy that make the same PNL source of the market.
to prevent overtilt of allocation when forming alphas portfolio to deploy on live trading. This is what I just shared. Okay. Okay, so by the way, I'm using Pro Plan for there's some multiple model here for Nyrobrain. There's Flash, Pro, and Max Ultra. Yeah, so you guys can test it out on yourself. And this takes me around 30 minutes because I still remember I'm trying to test it out and I'm doing Nyrobrain at the same time. I'm watching some YouTube videos. So after I finish the YouTube video, then the result came out and looked quite good. Yeah, this is also one of the results. Yeah. So you guys can be more active here, talk more, chat more, give me more emoji if can. Okay, so I'm more driven. All right. It is good. Yes, forum helpful. Yeah, the $50 plan indeed is like for BTC data only. Yeah. How much token was spent for this process until 20 alpha for a case? So 92 cents, I just now I showed already. 92 cents. Yeah, you can see the 92 cents here. Okay, I think this is like all for today. I hope the session helpful. You guys like, okay, how helpful is this session, do you guys think? Like 1 to 10, can give me an idea so that I also can do a survey. Is it like too deep, too hard to understand? Okay, 10, 10, 9. Okay, 11. Is it okay if is it like too hard to understand or like too technical? Try to like, if you guys like don't want to be too technical, I can be more general a bit. But of course, I would think technical definitely helps. Actually, technical part is also quite interesting one. After you have a good understanding of the fundamentals, you can like really customize based on the understanding you have and try it out of yourself, because now you get AI. You can just simply iterate the ideas based on the fundamental concept you just learned, even with the technicality. Okay, technical is good. Okay. Okay, understand. Chin Chong Yong, okay, 6. If you feel free, you can let me know what I can improve. Yeah. It's a brain better. Yeah, let me know how can improve. Wow, sorry, please. Okay, can. Okay, so I think that's all. Yes, that was already modeling. Yeah, modeling, I think is also the good first step for you guys to focus first. If you like really starting off, 3 main things, and the sequence will be alpha story first, try to find a good alpha angle. Second one is try to find model. Okay, good model, because if you have a good model and you have a good pre-training based on your list, you have a higher chances of getting a real signal out based on your alpha story. So after that, only regime filter. I think this is the first 3 things you can focus first. And the most important is the first 2. Even regime filter is also not so important, because if your alpha sucks, alpha idea sucks, and your model cannot capture it, and your regime filter is just a waste. Okay, I think this is all for today. Thank you for you guys for staying out so late. Okay, appreciate it. Okay, so we see you in the next week sessions. And again, encourage you guys to talk more in the Nyrobrain forum, make it active there. So each of you guys can get out of that value as much as possible. Okay, thank you guys. All right. Thank you.